Hi everybody, today we're looking at our latest grid trading strategy that we've introduced to our live trading rooms and our support on Telegram group. The reason for presenting this is the success rate. It is particularly good strategy. The grid trading strategy works all markets, whether it's shares end of day or trading the Dow 5 minutes. It works in all time frames, all markets, and the success rate is great because the most important thing about it is we're trading in the direction of the trend every time. It has excellent risk to reward, and stop losses are moved as we moved into profits, protecting our capital all the time. And look at a couple of examples just as an introduction, and we're going to start with the Dow hourly. As an introduction, the Dow hourly, triggers long would have taken place here, 23 to 38 to 50 to 61 to 77. So you can see just at a glance that as markets trend, we make money. And as they turn at the top and at the bottom, it stops us trading. Another nice example is the S&P on the end of day time frame. And you can see here in the direction of the trend, which we will discuss just now, there's our trigger long to take profit, trigger long again, take profit. And the last example here, just on the hourly chart, is the South African 40 or the ALSI. And once again, in the direction of the trend, long, take profit, long, take profit, long, take profit. And then in this final trade, we stopped out over there. So there's a couple of rules that we have to understand exactly where to fit the grid. That is really the challenge. And as a basic introduction for that, any market moves in threes. We get a trend, we get a retracement, and then we get a trend again. So the basic concept, and it originated from this observation that as markets trend, retrace, and trend again, if we took a Fibonacci level where the 100 was at the top, or the 0 at the top, and the 100 at the bottom, what we discovered is that if we get a setup where we start getting a trend, retracement, and trend again, where that support broke, we so often get an 89% retracement of this whole move. So the concept came in then is, first of all, identifying the trend and only trading in a certain direction. And the second challenge that we have was identifying exactly where to place the Fibonacci's. And that's really what we want to go into now. We applied an 8 and 21 exponential moving average, 8 being the green, 21 being the red. On condition that the 8 exponential moving average is above the 21, the trend is up. As soon as the green or the 8 is below the 21, the trend is down. We can only trade short. And once the green is above the red, we can only trade long. The next challenge is to determine exactly where to put the Fibonacci's. In order to do that, we need to know where the significant highs and significant lows are in the market. So if I just go back to a chart and let's just have a look. This is a significant high because the oscillator that we use, and the oscillator that we do use is the stochastic, and we use a 50-124 stochastic. Now, as an easy explanation, let's just understand that. If we suggest that markets trend, retrace, and trend, find a significant high, trend, retrace, trend, find a significant low, then it makes sense that that is not a significant high, that is not a significant low, that is not a significant low, that is not a significant high. So how do we define that? We look at the stochastic. And the stochastic oscillates between 100 and 0. So when observing the stochastic, because that was a significant low at the beginning, stochastic would come off through 0. It would trend, retrace, and hit 100, indicating to me that this is probably the end of the run, significant high. Once it had done that, it would trend, retrace, trend, and hit 0, indicating that that is the significant low. So in this example, that is the high, That is the low. So let's go back to that chart and have a look again. That is a significant high. Stochastic is at 100. That is not a significant high. That is not a significant low. Stochastic didn't quite hit 0. Not a significant high. Not a significant low. That is a significant low. Now, if we look at head on, you'll see that where I've labeled significant low, there's not quite at 0, but point to the left was at 0. And that is divergence. It's positive divergence. So positive and negative divergence does count when identifying significant highs and lows. To sum up, we're going to place the Fibonacci retracements always starting with 100 at the top at a significant high, and that because the stochastic was at 100, and the 0 of the Fibonacci at a significant low because the stochastic is at 0. So let's have a look at an example. For this example, I'm going to go to a currency pair, and there's two things we need to consider now. First of all, the significant high and low of the stochastic, so that is a significant high for me. Stochastic at 100, that is a significant low. Stochastic at 0, not quite, but coming off divergence. So we're going to draw the Fibonacci retracement starting at the significant high and drawing to the significant low. Okay, so we've identified the significant high and low using the stochastic. The second thing that we have to look at is the trend. Green below red, we only want to short. Green above red, we only want to long. Moving averages crossed over here. Highest point to the left is significant high, which talks to the stochastic. This is significant low, and what you'll notice about this example is that in order for this to be the significant low, green has to go above red. If that does take place, and this is a nice long-term picture, 4 hour, our next trigger to go long will be a break of the 23.6. Now the first thing we have to do is have a stop loss in the system, and that is simply going to be the level below the trigger line. So there it was a 23, so stop will be at 11. And then take profit will be the 38.2. We're just trading to the next level. That's all we're doing. Let's discuss the stop losses quickly. First of all, in order to execute a trade, the green EMA has crossed above the red EMA. In this example, the price level is broken up through the 61.8. The trade is taken. Take profit level is our next level up, which is the 77. Stop loss is at the 50. Now, as the trade moves halfway to target, in order to concentrate on risk to reward and capital preservation, my stop loss is also going to move halfway between the 50 and the 61. And in this particular example, you can see it got halfway to target, came down, and in effect hit a stop loss in this particular example. But let's go through some live examples. And what I want to stress here is we're looking at the Euro-USD currency pair again, but we want to focus on if this works out. And if working out is on condition that we get a moving average cross here and we trade long only in the direction of the trend. A long trigger would take place. Stop loss would be at 11. Once we reached halfway to target between the 23 and 38, stop loss would move up halfway. And by doing that, we're preserving capital the whole time. Let's look at another example rather. Okay, so green is above red. First long trigger will be 23 to 38. Initial stop loss is at 11. As we reached halfway to target, stop moved up. We hit take profit. As we broke the 38.2, trigger was taken, long was taken, target is 50. As we reached halfway, stop moved up. And so we continue and we just take it each level. Now, a lot of people have given me a shout and said, why don't we just hold one trade the whole way? What you're going to find as you start trading this, and you can see it very clearly here, is look at the support and resistance for a number of hours over there. number of hours over there, and that just goes to prove that these levels are so strong and they really do work. In this example ran all the way to the top, the 89% retracement. We didn't trade 89 to 100 because that's a no trading zone, and as it broke up again we would find new significant highs, and then the Fibonacci levels will be drawn in different places. Okay, if you are interested in seeing us trade this particular strategy live, we do 6 hours of webinars per day trading various world markets in different time frames using this particular strategy. You can watch us trade, you can hear our voice, and it is nice and interactive, which means you can ask questions about this strategy as we go along and as we trade it together. Okay, if you want to learn more about this strategy and other strategies, register for our upcoming live trading days, which are run on Zoom. Fill in your details. One of our guys will be in touch and confirm exactly which time it is, which date it is, and we'll give you a link to the webinar. Thank you so much for attending this session.